everybody do today? Not too bad, hopefully. We're gonna talk about selling puts, calls, all of that today. I have done streams on this before, so if I don't explain anything in detail enough to you guys, let me know. And you can go back and check those out. Ryan, I stopped out of a lot of stuff. Who stopped out of a lot of stuff that ended up ripping today? Who ended up stopping out and then it reversed today? Me with Tesla. If I would have ended up holding my position on Tesla, I would have. Well, if I would have held all my positions today, I would have went from negative 5,000 today to like negative 1,200. Diamond hands all day, only because I was busy. Good move. Instead, I was down like 5,000. Now I'm down like 3,800. So, you know, it's all good. But that's why you guys shouldn't freak out. You know, if some shit happens, if you sell and then it reverses, there's always opportunities, right? Like, for anybody who got into Snap with us today, holy shit. I mean, this thing went from 60 to 72 in like 2 hours. It's 21% move, right? Really good play there. Sono, really good play there. Uber, I'm up a little bit already, like $50. I'm going to pull back and move more towards shares as the weeks come by. Just honestly, for a couple of reasons. Number one, just because the market's a little more volatile. And number two, like, I cannot do my job appropriately if I'm stressed. Like, I just can't. I can't be a good teacher if I'm stressed. I can't create videos, I believe, as well when I'm stressed. I can't lecture as much when I'm stressed. I don't work out as much when I'm stressed. I binge eat when I'm stressed. So, you know, lowering stress is extremely important. And when I'm trading shares, I'm not ever stressed. Today I had a really good play on TNA, made almost 79% selling puts. So very, very happy about that. We'll talk about that play. We'll talk about selling puts in general within this stream. I'm going to try to keep it a little short since I feel like 90% of you guys, maybe 70% of you guys know what selling puts are. So we're going to talk about that. And then next week, we're going to talk about spreads, because spreads are sort of the same type of thing. But instead, you're kind of putting an insurance policy in place for you. But yeah, I mean, the biggest problem that I had, the reason, if we talk about, you know, today, to briefly wrap up while we're waiting for some people to hop on, the biggest problem for me today was I just had too much money in the market. Like that, I had way too much money in Tesla. I sold at the worst time. I had way too much money in Uber, sold at the worst time. Too much money in Facebook options, sold at, like, I just had too much money in. If I had small positions, you know, so whatever. Like, look at Snapchat. It's a great example. So I'm only in with like $2,500 on Snapchat because I was driving and I didn't want to crash on the highway. I'm up like 17% because I'm only in with like 20 something, $2,300. If I was in with 10 grand, I probably would have sold at $65, which granted, I would have made more money because I had more money at risk. But I'm really trying to scale back and focus on smaller positions and just taking all the positions that I see that I like. Because, you know, it's a long-term game. I don't care how much I make, you know, today or tomorrow. It doesn't matter. All it's gonna do is make a good Instagram post or something, and none of that shit matters. What matters is your long-term success as a trader, and ultimately your stress and your risk management. So for anybody who sold today and then the market recovered, you didn't do anything wrong. Here's the thing, like, where I fucked up was not by selling today. So for anybody who's like, oh, you know, I sold and the market, you didn't fuck up. Where you probably fucked up was you put way too much money in, or you didn't cut it earlier, right? Because, like, let's just take a look at Tesla, for instance, and then we'll kind of just, you know, talk about options and stuff. But like, let's look at Tesla. Let's look at the daily chart. So two things. Number one, I entered with too much money. I started my position at 10 G's. I added another 10 G's at 720, and then I added another 10 G's like it closed yesterday. So it was in with like 30 grand. So what I should have either done was just cut the position when we broke support at 770 and lost like $600, or what I should have done was just kept the money I had in it and just let it do its thing, which is what I ultimately should have done. So for me, and maybe for some of you guys, what happened was it wasn't necessarily that, you know, you sold at the wrong time. It was the fact that you entered with just too much money. You know what I mean? It's different, might be different for you guys too. But yeah, I mean, if you're somebody who got beat up today, trade shares. It's the easiest way to do this. You share your screen. Sorry. Yeah. So for anybody who wants to watch both my screens, because I'm probably going to be doing some terrible drawings, you can go check out the YouTube link if you just want to watch my screen on TD. I'm going to have that here. I had stops low enough. I didn't think they would hit. I mean, you know, shit happens. Today, shit happens. But the biggest thing is you can't get discouraged on these days. Like, you really can't, because look at how we've been trading for the past 6 months. You know, you can't let a bad week ruin the past 6 months of banging trading and the amazing trades that we're already putting on again. Like, you can't let one, you know, everybody loses. Even the best lose. The best fighters lose. The best, football teams lose. The best people lose. And it's how you respond to a day like, I said it earlier, but it's how you respond to a day like today that's going to tell me if you're a professional or if you're not, you know. And if you try to go out and recoup this money as fast as you possibly can, you're going to get screwed. You know what I mean? I went from 1K to 11K last year, now back to 8 grand because of the drop. But here's the thing, Drac. You made 800% returns. Like, fuck the fact that you're down to 8 grand. You made 800% returns. You know, Jesus, that's fucking insane. If you were to put your money in the S&P 500, you would have made 20%. You know, like, it's tough because it's hard for people to look at that like that. You know what I mean? Like, I was up 60% and now I'm up like 54 or 44% in the past 3 months. Dude, that's fucking phenomenal. Like, that's still amazing. I'm still happy as a pig and shit. You know? But that's the problem, is it's one of those things where, you know, like, that's just the ride. That's the wave, right? And then Drac, you'll go from 8 to back up to 11 and then back up to 12. And the thing too is, like, what's that 4 grand gonna do, or 3 grand gonna do for you right now anyway? Nothing. Like, it's nice to look at, but it's not gonna do anything for you. You know what I mean? I mean, it'll help you make more money, but at the end of the day, it's more about learning, you know, the repetition of doing what's correct and what's right as a trader now. So congratulations, still killing it. That's all that matters. Probably not. Kathy Wood bought 12,000 shares. Probably not. She'll probably average down. She has a big. Okay, let's talk one more thing before we get on here. All right, Workhorse. Who understands this Workhorse situation? For anybody, you guys know what Workhorse is, why this is down, and why, in my opinion, this is what's fucked up with the stock market. I'm in a very cursy mood. I'm sorry. I think I curse more when it's the afternoon streams because I'm like more awake and I have a lot of coffee and I just hit the gym. So, all right. So let's talk about this. So Workhorse, they're an electric vehicle company, but what they're really going for is commercial vehicles. So there's companies like Tesla that are making, obviously, like cars, you know, and trucks for everyday consumers. And then they're also making like freight trucks. So like big trucks, 18 wheelers. What Workhorse is focusing on, as well as a lot of other companies, but what Workhorse is focusing on more specifically is those, I think they're called, like, I forget the exact type of car. I want to say it's like B2B, but the vehicles that do deliveries that aren't 18 wheelers. So not 18 wheelers, but those smaller cars. So like the USPS, those little box trucks that they have, those Amazon trucks that deliver around you guys. Like, if you see an Amazon driver, they're driving around in those. You know, FedEx has them, UPS has them, DHL, like all those different types of cars. So essentially, there's already people really focusing on 18 wheelers, but then those other trucks come and pick up those from distribution centers and then send them to your house. So there was huge news circulating last February. So look at, you know, you can see this big push that happened here on Workhorse. And then I think it was like, it might have been the end of last year. No, I'm sorry. I'm thinking the end of 2019. But there was this huge contract that the USPS, so basically the postal system, was putting out for, like, it was an insane amount of money. I forget the exact amount. If somebody knows offhand, shoot it in the messages or in the thread and I'll see it. But I forget the exact amount, but it was an insane amount of money. And it was said that it was between like Oshkosh, Workhorse, and then there was some other company, I forget. But it was essentially implied that that contract was going to Workhorse. It was implied. Workhorse also got into this bubble territory because of people like Cathie Wood. As much as I like her and as much as I look up to her, she is another, not she, but her followers are another problem with the stock market. They just push anything this woman touches, which overall she hasn't been wrong about a lot, so I understand. But so you get this massive push because they're buying, ARK is buying all the time. There's this contract that's supposed to go through that essentially, quote unquote, Workhorse had in the bag. And this contract was supposed to come out in February. It got delayed. Or March, and it got delayed because of COVID. Then the contract was supposed to come out in October of 2020. Got delayed. Still, Workhorse is pumping like a son of a bitch. And then it was supposed to come out recently, and we saw this major pump and breakout out of Workhorse. And then it comes out today that they're not getting that contract. Oshkosh is getting the contract. And so it's fucking baffling to me that this stock in a single day shaves 60% of its market cap off in a day, which means 60% of the value of this company was based off of one contract, a huge contract, mind you, but one contract that was not even a done deal. And that's what disgusts me about the stock market right now, because we have these companies that are dumb overvalued on news. On news. You know what I mean? Like, it's on news. It's not even like they were for sure going to get the contract. It's in hopes that they were going to get a contract. The first was talked about last year. And so that's what disgusts me. Like, can you imagine if there came out that like Apple was going to do like $100 billion deal with like Amazon, and it was just news, and then like Apple tripled that year? Like, that's ridiculous. And like, it happens with these smaller cap companies simply because it's usually more risky and volatile people. So yeah, I agree. Wild speculation, especially in EVs, everywhere. Yeah, I mean, and that's what I was talking about yesterday. Like, don't try to find the next Tesla, right? Like, because if you're trading something that has 60% of its worth down the drain on a single contract. And here's the thing too, right? If you look, they have earnings coming up. That's probably going to be shit too, I would assume. Because if you look at the financials of the company prior to this, they were trash. They were really not doing any sales at all. Like, they were not doing any sales. They really weren't. And so it's like, they don't even have a full product out, I think, yet. So you see things like Workhorse, you see things like Nikola, like, that's basically the thing. But that's what you need to watch out for is why something like this is trading the way that it's trading, And I'm not saying that Workhorse can't have a fantastic future. But it's one of those things where it's like, you can't trade or invest in something that doesn't even have a contract yet. Is this a good time to buy Workhorse? If you're buying long term, $15 is not bad. However, I think that there is a very high chance Workhorse can go back down to $2. Because the only thing holding it up right now is Cathie Wood is buying it, and she bought a ton yesterday and just lost a shitload of money. Where can I find the formula for how much a share price should be? Okay, so that is a very vague and tough answer to give you. It's in the stock, like in the world of investing, I shouldn't even say, not even the world of stocks, but in the world of investing, the formula for finding out what a stock is worth is like, finding true value is not a simple formula. It's not, one of those things where it's like, this is how you do it. This is how you find out how much a stock could be worth. There really is none. What you need to look at is forward earnings and PE ratios. And PE ratios now, like how Warren Buffett and Benjamin Graham and Charlie Munger, like how they actually would value a stock, I don't think like that works anymore, because we trade at such ridiculous PEs that you just can't do that anymore. You really can't. Like, so from an investing standpoint, like you can't just find a formula. Normally it was look at the PE ratio and then figure out, you know, what's the price to earnings and then what's their forward PE and then how does that stack up against the rest. But now you have a tech world where we're trading at like ridiculous PEs. You know what I mean? Not saying other EV companies won't have success, but don't imagine Tesla type gains. Yeah, I mean, and you have to realize too, like Tesla is one of those outliers because they've been doing it for so long that, you know, like Teslas in general, from everything that I've seen, and I still want to buy one, they're not the best cars. Like they're not built really well. Let's be honest. You're buying it because of the technology that's inside of the car. Right? A lot of them come off the assembly line messed up, you know, like not fully painted, door jambs are fucked up. Like they're not the best cars. You're buying the technology behind it, and it's kind of like a status symbol nowadays. Like not like a status symbol like look how successful I am, because they're not expensive cars, but more of like a kind of how the Prius was in 2008. I don't know if any of you guys are old enough, but in 2008 everyone in San Francisco was buying Priuses because it was like the cool hippie thing to do. Like, you know, like to buy a hybrid and save the planet and stuff, you know what I mean? Yeah, and I think too, like Josh, you said like Ford, GM, Odyssey, and Volkswagen. I agree. Like Volvo, they're not making any more ICE engines. Just made me laugh out. But the Prius. But yeah, I mean all these other companies are going to catch up. But what you're buying with Tesla is Tesla's this weird thing, and I know we got to talk about selling puts because I'm gonna just sit here and shoot the shit forever, but Tesla's a weird one because not only are you buying an energy company, you're buying a battery company, you're buying a car company, and you're buying a technology company, right? Like you're buying all of those that are, you know, you're buying all of those things, and you're buying a cult following company, you know, like Kendo said, like Apple. Like there are people who legit buy Apple products because of the operating system, people like me, even though I know you can get a much better product from a spec standpoint somewhere else. I have a $5,700 MacBook Paperweight sitting behind me on my desk that I don't ever use because the $2,200, you know, PC that I bought pre-built is 5 times as strong as it. You know what I mean? But it's the cult following, it's the ease of access. Like the reason you buy Apple is so you can use it with your Apple products seamlessly. That's why you buy it. And once you're in the Apple ecosystem and they have the hooks in your back, you can never leave. And so, yeah, long story short, don't buy the hype. Also, don't sell the hype. You know, like don't fall into the, you know, the sky is falling. Like look at today. I sold out of a lot of my positions, but simply because I had too much money. But if you believe confidently in something, and especially if you're trading shares, which we're talking about more now, you know, don't worry about what the sky is falling. Don't fall into the FOMO. It's tough. It's tough to say that, but you know, don't fall into the FOMO. And we'll see what happens. I think Workhorse is going to bounce heavy tomorrow, but I think it's going to be short-lived. I think there's going to be a lot of people like, oh, let's get in as soon as we possibly can. It'll probably push back up to 20 and then eventually die. Let's get into selling puts. Okay, so we all understand Tesla, another thing, they sell all their cars at a loss. Yeah, Tesla has to really work on their margins for sure. Also, too, I think if Tesla can get out to like a 2-seater, $20,000 car, that'll be a big thing for them too. But all right, so let's get into selling puts. Everyone here understands options basics. Right? If you don't understand what a call, what a put is, how they work, how they move, go back and watch the stream that we did last week. I talked all about it. So if you don't understand calls and puts, you might want to sit this one out and go back and watch, or take watch the lectures and take the courses on options in the academy. All right, so we all know, what's it called? Okay. So we all know, let me just get out of this. All right, I'm going to stop streaming on, there we go, on Discord, and I'm going to use my crappy little sketch pad. And if you guys want to watch on Discord, you guys can check it out now. Okay, this is like this crappy little sketch pad I use, but it gets the job done. Okay, never mind, it doesn't. Can I just, like, there has to be an easier way to, like, delete all this rather than me just clicking. All right, so in the world of options, let's talk about this now. Can I use green? Okay, cool. Let's go. All right, so in the world of options, the Pete drawings, dude, these are the worst. All right, so we have, this is how your options are going to end up looking. Who's that Pokemon? What's this drawing gonna be? Okay, so bear with me a second. This is how this is gonna look. So this side over here is going to be the buy side. So on every single transaction that you have, you're always going to have a buyer and you're always going to have a seller. So what do you think is going to happen to a stock if you're buying a call? And there's no wrong answer, so if you throw something out wrong, I'm not going to be like, ah, you didn't know it. But what if you're buying a call, what do you expect the market to do or the stock to do? Go up. Okay. If you're buying a put, what do you expect the market to do? Go down. Okay. Now, there's someone on the opposite side for everything. So if you're buying a call, you think the market's going to go up. What does the person on the other end of that transaction think? They think the opposite. So if someone's buying a call, they think the market's going to go up. So that means if I'm selling somebody a call, I think the market's going to go down. So it just, remember, it's the opposite. So if you are selling a call, you expect the market to go down. So if someone's buying a put, what do they expect? The market to go down. That means if you're selling a put, you expect the market to go up. Correct. Everybody understand that. You buy a call, you think it's going to go up. You sell a call, you think it's going to go down. I'll write it out here. Buying a call, think it will go up. Sell call, think it will go down. Buy a put, think it will go down. Sell put, think it will go up. So it's just the opposite. There is somebody at the other end of every single transaction in the stock market. So, you know, when you're buying calls on Uber today, or you're buying calls on Snapchat, somebody is selling you that call. Somebody thinks the opposite of what you think. So what are some downsides? I can delete all this now. What are some downsides to buying an option? So if you're going to go out and you're going to buy an option, what are some downsides? Okay, time decay. Okay, then they can expire worthless. Exactly. So time decay. Here's another one. Pinpoint timing. So when you're buying with shares, like, it doesn't matter, right? Like, let's say like I'm buying with shares today on American Airlines. If American Airlines doesn't go up tomorrow or the next day, it's not that big of a deal. Like, it's really not that big of a deal, because worst comes to worst, like, I own the shares, so who cares? However, when you're trading options, what the fuck? Okay, sorry. When you're trading options, however, it's very different, because you have to time it perfectly, because you have to pick a specific date, you have to pick a specific strike, and you have to fight against theta decay. All right, so options, downsides, time decay, pinpoint timing, could expire, worthless. These are the biggest downfalls when it comes to this, right? Now, what are some of the biggest upsides to trading options? Biggest upside to trading options. Okay. Unlimited profit. There really is an unlimited amount of money you can make. Less capital. You don't need a ton of money to trade options. Right? So unlimited profit, less capital. And that's really it, to be quite honest. Bigger gains. Now, let's play this game. So when you're selling a put, you're doing the opposite. So let's say selling put upside. So if I'm selling a put, which means I think the stock is going to go I think the stock is going to go up. What do you think are some upsides? If it's the exact opposite, what do you think is going to be the upside? So the downside on options is time decay, right? So one of the upsides to selling a put, time decay, is our weapon. I will be right back. I gotta pee so bad. Hang on. Oh, sorry guys. I literally do not drink enough water, and so I'm forcing myself to drink as much as I possibly can. And it's like, jeez. Okay, all right. Let's get back to this. Wiz Khalifa. Let's get back into it. So, all right. So if one of the downsides of buying an option is time decay, one of the upsides to selling an option is time decay. What happens when you're holding an option, right? What happens? What is time decay? How does that affect your option? It's eating it, right? Or literally every single day that you own an option, there is money being taken out of it. Where does that money go? If every day you're losing money holding an option, where does that money go? To the seller. Exactly. A lot of people, including myself when I started, thought that it just like either disappeared into the atmosphere or like brokers took it. But it's not. It's literally constantly going to the seller. I will talk about this. So time decay is our weapon. Okay. More relaxed timing. We don't have to be pinpoint. Depending on like when you sell it for, you don't really have to, honestly, you don't really have to worry about your timing that much. One last thing, the opposite of expiring worthless. So in this case, worst case scenario, you buy shares. If you're selling puts, which this is mainly what I recommend you guys doing, but we'll talk about it. If you sell puts. Okay, what are some of the selling downsides? What are some downsides to selling options? Yep. Capped profits. So I'll show you when we start looking at some real-time examples, but you can only make a certain amount of money. So on that TNA option that I sold today, the max that I could give up, the max I could make, was 550 bucks. And so that's why I sold it today. I day traded it because I was up 79%. So why am I going to tie up all that money just to make another 20% return when I could put that on something else? Okay, another downside is capital gains. So it does count as trading. So you do have to pay capital gains tax. Okay. More capital to play. So if you're selling a put, you need 100. They're going to take a collateral, and we're going to talk about this. But you need whatever the price of the stock is times 100. So if you're selling if you're selling a put on the S&P 500, you need $38,000. If you're selling a put on Uber, you need $5,500. If you're selling a put on something that costs $10, you need $1,000. It requires more capital. Let's talk about one more thing because I didn't think about this as much. What is another downside to options? Not much consistency. It's very hard to be consistent with options. Now, like, we have been able to be consistent, but overall, like 90% of people have problems, serious problems being consistent. What is one good thing about selling puts? Consistent income. It is very, very, very easy. And we'll talk about this. Consistent income. It is very, very easy for you to make 1 to 3% per week selling puts. Very easy. So, think about right now, I tied up $16,000 and I made $400 today. So today alone. So 16,000 times 0.03. So I made about 3% returns today on one trade that I had a 70% chance of making money on. Right? Huge. So that right there, the major downside to owning options, just to buying them, is time decay. You have to time it perfectly. They have the chance to expire worthless, and there is not much consistency, and or it's extremely hard to be consistent. One of the biggest upsides, though, is unlimited profits, and there's not a lot of capital to play with. You don't need a ton of money. You could buy options and trade options with $500. You can't do that if you're selling puts. The upside to selling options is time decay is your weapon. You have much more relaxed timing. Worst case scenario, if you're selling puts, you just buy the options, and it's more of a consistent income. The downside is that you cap your profits. You have to pay capital gains tax, which you do with normal options anyway, and you need more capital to play. So let's go over, what the hell? Okay, so let me get rid of this and let's talk about a specific option today. And it's going to be tough for you guys to follow along with me if you can't see my screen, but you guys will get a gist of it. Let me disconnect and reconnect. So if anybody wants to get back, you can reconnect. All right, so let's talk about this today. let's talk about TNA. Does anybody not know how to read an options chain? Does anybody know not how to read? Does anybody not know how to read, I should say, an option chain? If you don't, and you don't want to speak up, I'm going to drop a link I made on how to read the options chain, and I think I go over, I know I go over Thinkorswim. I think I go over Robinhood too. So definitely check this out because it's a very important video. But let's talk about this. So TNA. Now we're gonna talk about selling puts first. Your goal, I'm gonna write it down in the Discord. Goal when selling puts. You do not want the stock to close below the strike you are selling at. So for instance, take a look at TNA. When I bought TNA today, it was sitting at a very strong support. I'm sorry, when I sold a put on TNA today, it was sitting at a very, very strong support of $87. I thought to myself, I do not think that there's any way that TNA is going to close below $83 by Friday. So I sold a put for $83. The way that you sell a put, you go to trade. Now, if you're on Robinhood, what you would do is go to your options, and at the top left, you would change it from to put. You would change it from call to put, and then you would change it from buy to sell. We are selling a put. Now, what all you do on TD, which is what I love, is you find the strike that you're looking for. So for in this case, I sold the 83. What you have to realize is these premiums are much different now. All you do is right click, hit sell, and hit single. Don't worry about any of this crap down the bottom. Sell single. And you can see here that if I were to sell one of these options, or hit confirm and send, they're going to take collateral. Remember we talked about collateral? They're going to take the price of the stock. So in this case, $93. Or I'm sorry, they're going to take your strike. So $83 times 100. So they're going to hold $8,300 aside for me called collateral. And I'm going to get $65. Now, if when Friday comes, TNA closes above $83, I get all of my money back and I get to keep my $63. Do we all understand that? Is anybody lost? When you sell a put, you want the stock to close above your strike. So in my case, I wanted it to close above 83. Now, if we were buying calls, because when I'm selling puts, I think the stock's going to go up. If I was buying calls, what does the stock have to do in order for me to make money? If I bought calls on TNA, what does the stock have to do in order for me to make money? It has to go up. Yeah, it's got to go up. What's going to happen if the stock sits sideways for 5 days? Am I going to make money or lose money if the stock sits sideways and I own calls? I'm going to lose money because there's time decay. If the stock sits sideways for 5 days in a row, I'm going to lose money. So here's the beauty. Here's the secret sauce to puts. I sold these puts. If the stock goes up, I make money. If the stock goes down, if the stock could dump 7% down to $85, I make all of my premium. So today, I had $500 that I could make by Friday. So that means that if TNA went up like it did, I'll make $500. If the stock goes sideways, I'll make $500. The stock could go all the way down to $50. But as long as by the time of my expiration, it is even a penny above $83, I make all my money. So if you're buying calls, guess what? You only make money if the stock goes up. If you're selling puts, You make money if the stock goes up, you make money if the stock goes sideways, and you make money if the stock goes down as long as it closes above your strike. All right. So now what happens? Does anybody know what happens if the stock closes below my strike? So let's say TNA didn't bounce and it dumps down to 80 bucks and I sold puts at 83. What happens? No, I don't lose everything actually. I'm forced. There's no option here. You guys have to remember this. It's not optional. I am forced to buy 100 shares of TNA. Like, I'm actually forced. They took that money from me when I opened the position, and I'm forced to buy the shares. So, you know, if I'm doing this on Apple, oh no, I gotta buy Apple stock. Like, that's not a fucking, like, that's not a big problem. You know what I mean? So I really only say do this for companies that you actually like, that the worst thing that happens is you get stuck buying the stock. You know what I mean? So for me, the worst thing that would happen, I'd be stuck buying TNA at $83 a share. This is why you want to do this with stocks that are consistently going up. Puts are not optional, but calls are, depending if they get executed. Exactly. Puts are not optional. You are forced to buy it. So let's take a look at some real world examples here. And we'll talk, for instance, here about Uber. So Uber is setting up really, really well. And let's say that you wanted to sell puts. So Uber is trading at $55 or $56 a share right now. There's a very strong support at 55. So I think there's no way that it's going to close next Friday below $53. I think there's no way it's going to close below 53 by next Friday. And if it does close below 53 by next Friday, I don't mind buying them at 53. I don't care. So we're going to go over, we're going to look at next week. So we're going to look at March 5th. And we're going to look at those $53 puts. Now, we have a 70% chance of making money. Like those odds, right? 70% chance of making money. Now, if I sell these $53 puts, I will get $85 in premium. But I have to put up $5,600 worth of collateral, which really, when you think about it, that's not bad at all. You're making 1.5% returns in a week. Would you guys all take 100, or would you guys all take like 70 to 80% returns a year every year? If I said to you, there's a 70% chance that you can make 70 to 80% returns a year every single year. Would you take it? Fuck yes, I would. For sure. You know what I mean? Like, it's not thousands of percent, but that compounded over years and years and years and years. And on top of that, you guys have to realize this. You'd have a 70% chance of making money without black box, without an edge, without, you know, like, that's just the numbers. That's just statistics. That's without you having an edge. That's without all of us collectively working together. That's without having technical analysis. That's without anything at all. Without anything at all. That is your chances of making money. So in my opinion, if you were to sell this 53, I think you have a 90% chance of making money. I really do. With the amount of flow coming in, with the major support coming in, with how we're looking right now, with the way the technicals are setting up, I think you got a 90% chance of making money. So you tie up $5,600 for a week and you make 85. It's not bad. Now, what makes premiums higher? What Greek makes your premiums higher? Matt hit the nail on the head. Implied volatility. When implied volatility is through the roof, premiums are worth more, which means that you are going to make more money if you're selling puts when implied volatility is high. It's the opposite. If you're buying a put, you don't want to, like, if you're buying a put or you're buying a call, you don't want IVs to be high. Ryan, how do you tell the percent of it happening? Okay, so here's the thing. If you're on TD, which I think you have TD, or do you have Fidelity? I don't know. It's different. You have TOS. Okay, so here's how you have to do it. You guys aren't going to be able to see on my screen because for some reason it doesn't show me. It doesn't show the box, but here's what you have to do. You have to go up to the trade section. I'm sorry. Yeah, you have to go up to trade, and then you have to go to like your all products. It'll say trade and all products. And once you get to this screen, What you have to do is go right here. It'll say layout. If you see it right here, I'll actually put a screenshot. Layout. Red. Layout. Okay, here we go. So for anybody who needs to know, on Robinhood, it'll just straight tell you, but you go to layout up here. And when you click layout, you go to customize and you'll see customize, hit that. And on the left, you want to find probability OTM, which means what's the probability that this is going to expire worthless? There's a 70% chance that that's going to expire worthless, which is good. You want a higher probability of it expiring worthless because you're on the opposite side. Which means if somebody buys that put from you, they have a 30% chance of being right. That's pretty bad. So in this case, you know, Uber closes above 53. I get to keep my 60 something or my 80 something dollars, my $84. Now let's look at something like TNA. Right, TNA, triple leveraged ETF for small caps. I love selling puts on this because look, it's a consistent uptrend. It's getting a little dicey now. Look how high the implied volatility is. 80 to 100%. The implied volatility on Uber was like 40 to 50%. So look at how crazy this is. For instance, if we look at March 5th, if I were to sell a put on TNA for $85, 85 bucks, that's going to cost $8,500. Actually, let's look at this one. It's a little bit better. $89. So that would cost $8,900 and I would make $380 in a week. So you tie up $8,900 and you're going to end up making 5%. 5% in a week. How many of you guys would take 5% a week? You have like a 70% chance of making money. 5% a week is almost 260% returns a year. That's pretty crazy. Now, I don't do this a lot anymore because it would bore you guys. Right? Like I unfortunately, while I'm here to help you guys make money, I feel like myself, I'm here to entertain you. If I was just like selling another put on TNA, selling another put on this, like, you know what I mean? Like that's not, a lot of you people aren't here to make 1% a week, 2% a week. You guys are here to make more. So that's my job too. But what I like to do is sell puts on shit that has massive flow. And now this is what we're going to talk about now because this is important. So you guys know premiums. Let me ask you a question. What causes, so we talked about what causes premiums to be higher. Is a premium at the money going to be worth more than a premium out of the money? So if let's look at TNA. TNA is trading right now at 94. You can see here, $93. The premium's $500. So the closer to in the money, the higher the premium is going to be. Why? If the closer to the price of the stock right now or in the money, the closer to that, the higher the premium, which means the more money you're going to make. Why is that more money? So let's break this down. All right, if I were to sell a $93 put for next Friday, I would make $500 on a $9,300 investment, which is freaking huge. I have a 48% chance of making money. Or I could do the $83 put. I'd only make $200, but I have a 72% chance of making money. Why would I get paid more for the $93 put? Why would I get paid double for the $93 put as opposed to the $83 put? Because I have a higher chance of losing money. So if I sell the $93 put, I only have a 48% chance of making money. If I sell the $83 put, I have a 73% chance of making money. So the safer that you play, the less money you're going to make. Right? The safer, the further out of the money you go, the less money you're going to make. We all understand? The safer the play, the less money you're going to make. The more risky the play, the more money you're going to make. Because, I mean, look at it. Like, let's look at TNA right now. So here's the thing with TNA. In order for it to close above 93, it can't go down. Like, if you want it to close above 93, it cannot go down at all. However, if you wanted to close above 83, it could dump 11% and you'd still make money. So the higher the chance you have of making money, the less money you're going to get paid. So now imagine if big flows come in on Uber and they're all for like next Friday. Big money's buying the shit out of this. It's sitting at major support. Technicals are looking favorable. Well, here's the thing. You could sell a put for like $56. And you'd have a 48% chance of making money, but because it matches all of your criteria, you can make 5% in a week by selling the $56 put. And that's why I like to sell puts at the money, because I'm going to make a higher premium. And while it is riskier, right? While it is a much riskier way to make your money, much riskier way to sell your puts, you're going to make more money. So what I like to do is find something that has strong flow, find something that's setting up beautifully technically, and then sell a put on it. And to give you guys an understanding of how fucking powerful this is, compound interest calculator, Money Chimp is my favorite. So let's say that we can, I mean, and here's the thing, guys, we can pretty easily make we can for sure make 1% returns a year, for sure. So let's say that you only have $5,000 right now, and you're going to put no money into this account, and we're going to give this account 35 years to grow, and you're going to make 52% return a year. You can damn near easily, like a 95% chance, make 1% return a week. You would have $11 billion in 35 years. But Pete, what if I die? I don't want to wait that long to have $11 billion. Okay, fuck it, right? 10 years. You'd have $329,000 10 years from now. And that's not putting any money in the market at all. Like nothing. That's, you start with $5,000, you sell puts on it. 10 years from now, you have $329,000. Okay. Let's say you push it and you can get 100% returns a year, which I can pretty easily do that if I'm selling puts, to be quite honest. Today alone, I made 3%, but pretty easily you can make 2% a week. That means we'd make 104% returns a year. That means you have $6 million in 10 years. If you started with $5,000 today and you made 2% a week, you'd make $6 million. Yeah, so the downside wayside is trading them is boring and it requires a good amount of money. Like, you can't do this unless you have minimally $5,000, but really like $30,000 is when this shit starts to really start to compile. Now, let's say you play super aggressive, right? And you could squeak out 200% returns in a year. You're looking at $300 million in 10 years. So one of my main goals with all of the money that I make from this academy is to start a puts, just selling puts for the year of 2020. So like, let's say like in the one account I have right now, I'm planning to start with like probably $10,000. And then every single month, I plan to put at least $2,500 to $3,000 in. I really want to put about $2,500 a month in. So 2,500 times 12 is $30,000 per year minimum I want to put in. And I think that I could pretty easily, without like managing it every single day, but I could pretty easily make at least 2.5% returns a week. So 2.5 times 52 weeks is 130% a year. 10 years from now, that money will be worth $261 million. And I pretty easily can do that. The biggest downside is it's boring. Now, what is another downside of this? If you're trading with a crap ton of money, what is a downside? What becomes problematic when you're trading with a lot of money? Liquidity. Like when you're moving that kind of money around, well, you can lose a lot. That's true. But here's the thing. If you're trading with $40,000, $50,000, don't be selling puts on TNA. You know, sell puts on Apple, sell puts on Tesla, sell puts on those types of companies. Because the worst thing that happens, like say you were selling puts this week, you buy the shares. Oh no, I own $40,000 worth of Apple. Worst comes to worst, you take a break from trading and you just hold the Apple until it recovers. You know what I mean? That's the worst case scenario. But you shouldn't be selling puts on things like TNA. TNA, like when you have a ton of money, TNA is really, really, really good for somebody who doesn't have a ton of money because you can get huge returns with not putting a lot of money up at risk. All right, so that's selling puts. Selling puts, in my opinion, is one of the best strategies that you can do, and I'm going to start utilizing it a little bit more in my trading in the next couple of months. But I am going to stick to a lot of shares too. That's really what I'm going to stick with, is a lot of shares. Selling puts is great though, especially during times like this week where it looks like the market's going to recover, but there's still a lot of downside. Right, there's one last thing I want to talk to you guys about though, when it comes to selling puts, and then we're going to talk about covered calls. Right, all right, so now, if you buy something out of the money, like if you sell it out of the money option, you're going to get paid your premium quicker. Like if you look at the TNA I had, I made 70% returns today because it was so far out of the money. I'm not going to get paid as much, but the further out of the money you go, the quicker you'll get paid, but the less you'll get paid. If you pick something like, say you sell an Uber put, you sell a $56 put for next week, you're not going to see that move. Like you're not going to make a lot of money this week. You're not going to make, like, think about an option. When do you lose the most amount on an option? A couple days till expiration. Once an option is like a week away from expiring, that thing fucking plummets so fast. Your theta becomes so crazy. Well, guess what? When you're selling an option, the opposite happens. The opposite happens. You make all your money a couple days into expiration. Now let's talk about selling calls. All right, here's the thing. Selling calls is a lot. I don't recommend selling calls at all. Unless you're doing covered calls, I don't recommend selling calls. Because here's the thing. I'll ask you guys again. Where does it say max profit? So your max profit is whatever the premium is, Ryan. So if the premium is like $250, that's your max profit. Whatever the premium is your max. So let's talk about puts one last time. When you sell a put, if you're wrong, what's the worst thing to happen? If you sell a put and you're wrong, what's the worst thing that happens? You own them. You buy the shares. Yep. Okay, what's the worst thing that happens if you sell a call? You got to sell those shares. So here's the thing. What happens if you don't own the shares? Oh, fuck, you owe that person a lot of money. So here's the thing. Have you guys ever heard of naked options? People think naked options is just buying an option without a spread. That's not true. A naked option is when you sell a call without owning the shares. So let's look at Tesla right now. And remember, when we're selling a call, we think the stock is going to go down. So let's look at the options chain for Tesla. Let's say there is no way in hell, I think Tesla will close above $905 by next Friday. In order for Tesla to close above $905 by next Friday, the stock would have to go up 30% in the next 7 days. 30%. There's no way in hell that's happening. And if you look at the numbers, we have a 77% chance. I'm sorry, a 96% chance that that's not going to happen. 96% chance. But here's the thing, right? So if we sell it and it closes below $905, what happens? We sell the calls, it closes below $905. We make all of our money because we were right. Okay, what happens if it closes above $905? We sell a call at 905 and it closes at 906. What happens? We owe that person 100 shares. Well, guess what? If you don't have 100 shares, you owe somebody $700,000. And so that's why you should never sell naked calls, ever. Now, what's a covered call? Does anybody know what a covered call is and what a covered call means? When you own the shares. Exactly. All right, so let's say that we own 100 shares of Tesla at $670. Let's say that while I own these shares, I sell a call at $905 and I make $200 in premium. Well, what happens if Tesla goes up to $750? If it goes up to $750, guess what? I just made 13% returns on my shares. And because it didn't go above my call, because it didn't go above $905, I make $200 worth of premium. That's fucking awesome, right? What happens if I sell the $905 call and it goes all the way up to $875? I still keep the $200 I made on my premium because the call's out of the money. Whoever bought that call lost a shitload of cash, and I made 30% returns on my shares. Sounds fucking awesome, right? Okay, what happens if Tesla closes above $905? I owe that person my 100 shares of Tesla. However, I did make 40% returns on the way up. So you get to keep the spread that you made on the way up, but you do owe 100 shares if they decide to execute. Most of the time they don't execute, but if you did execute, then you owe them 100 shares. Now, that's the downside. Let's talk about the wheel strategy. Okay, does anybody know what the wheel strategy is here? I see people typing. I know what the wheel is. I don't get how you make money when you pay so much in taxes. You pay a lot. On calls and puts, you keep the premium regardless of if it's assigned to you. Yes, true. Unless you sell it early, then you don't keep the whole premium. All right. let's do the wheel strategy on something easy like Uber. So, the way the wheel strategy starts is we start with nothing. We want to sell puts on Uber. So like I said, let's say we sell that $53 put on Uber. And let's say Uber closes above $53. Awesome. I just made $80. So what do? I sell another put. All right, let's say it closes above my strike. I make more money. Next week, I sell another put. Let's say it closes above my strike. I make more money. This is great. Now let's say that Uber's trading at $64 and I sell a put for 62 and it closes below 62. What happens? I get assigned the shares. So now that I own 100 shares of Uber, right? Now that I own 100 shares of Uber, what can I do? I can sell a covered call. Yeah. So now I own Uber at 62 bucks. I already made like $300 the 3 weeks prior by selling puts. Now I actually have them. And let's say I sell a $67 call and the stock goes up to 64. Okay, well, I keep $80 on the call and I make $250 because the shares went up 6%. Now let's say the next week I sell a $70 call. It closes at $69. Okay, now I keep the $80 and I made another $250 on my shares. Now let's say I sell a $75 call and Uber fucking rips. Some sort of news comes out, the stock goes through the roof, it hits $75. What happens? I sell my shares. I keep the profit I made though on the shares. I sell the shares, now I have nothing. But I did make a good amount of profit on the way up. So now what do? I sell puts again on Uber. And I keep selling puts and collecting money until I get assigned shares. Once I get assigned shares, I sell calls. I keep doing that and getting money. Once I get stuck selling the shares, then I go and I sell puts again. And that's why it's called a wheel, because you go from selling puts to buying shares to selling calls to selling puts to buying shares to selling calls to buying puts to selling shares, and it just goes in a wheel. And it's best to do this with stocks that like are pretty consistent in the upward trend. Anyone have any questions? So many advantages to have collateral. Yes, that's why the rich get richer and the poor get poorer. Because if you don't have a ton of money, you're forced buying a shitload of options and playing the losing game. But when you have a ton of money, you can just sell. So let's talk about two final things before we hop off. Number one, if you don't have enough money to sell puts, what do? If you don't have enough money to sell puts, what do? Credit and debit spreads. Let's fucking go. Yes. So if you don't have enough money to sell puts, what you should be doing is spreads, which we're going to talk about next week. Because in order to understand spreads, you have to understand puts and calls and selling them. But you do spreads or you trade shares. So say you have $4,000 right now. If you trade shares, pretty good chance you could probably make about 100% return this year. And next year, you'll be able to start selling puts. But selling puts is a great job for anybody who has a job already. Because you don't have to be watching the market every second of every day. And now we're going to talk about spreads. Well, here's the thing. You can sell puts on level 2. You can't do spreads on level 2, sadly. But let's talk about spreads. So a spread, quickly, I'm not going to talk about this too much because I want to go in depth next week. A spread is when you buy a put and you sell a put. So what a spread allows you to do is have an insurance policy against your position, and it also allows you to use less money. And we'll talk about that next week. You guys have any questions? If not, I'm going to hop off and make some dinner. Thanks. Yeah, no problem. I mean, selling puts is the way to go, guys. Like, it really is. You're not going to get massive returns, but even if you sell puts and then, trade shares, it's great return. You make good money. You really do. And the thing is, even if you're selling puts, one last thing, even if you're selling puts, you still have to trade. You still have to find good setups. You can't just sell puts and sell puts and sell puts. Like if you're selling puts on, like something I wouldn't sell puts on right now is MGM. MGM's through the fucking roof. Selling a put right now is not the smartest idea. You still have to be a trader. You still have to trade. You still have to be out there looking for deals. You still have to be doing what you're doing right now. You just don't have to be, you know, spot on the money when it comes to your moves. Damn, BCLI is down pretty heavy. All right, guys. Enjoy your night. Take some time off because today was a little rough, and we'll get back to it tomorrow. We'll see how the market is tomorrow. See if futures pump up, and we'll kind of see how things go. All right. All right. Cool. Thank you, guys. Enjoy your night. Peace.